Hello, welcome to Actuary Voices, the podcast from the American Academy of Actuaries. I'm your host for this episode, Ted Gotsch, and today we will be speaking to Rob Fischer, the Academy's Casualty Policy Project Manager, as well as Margo MacKenzie and Jeff Clinch, members of the Casualty Practice Council's Auto Insurance Committee, about the Academy's work in the auto insurance area at a time when outside influences are driving up costs for American consumers. Rob will lay the groundwork about what volunteers are working on in the space more generally, while Margo and Jeff will speak in depth about a recent issue brief looking at the effects of tariffs imposed by the Trump administration on auto insurance costs. Both Margo and Jeff were members of a working group that helped craft the document. Rob, Margo, and Jeff, welcome to Actuary Voices. I'm going to turn first to Rob to talk about the current state of vehicle insurance. So, Rob, how does the issue of availability and affordability come into play in auto insurance in 2026? Why is it so expensive?
Availability and affordability of insurance are two of the Casualty Practice Council's priorities for 2026. From the consumer perspective, on the auto side, auto insurance is required in pretty much every state. It's something that's, on the mind of everyone, every 6 months when they have to redo their policy or when they buy a new vehicle. And accidents happen. It's just important to be properly covered in case of an emergency situation. So the last few years, affordability challenges that have arisen, I would say, are mainly due to can be tracked based on accident frequency and severity. So some of the examples of things that are impacting everyone's affordability of their insurance is inflation going into cost of vehicle repair. It also kind of goes into one of the impacts that Jeff and Margo are going to cover on the tariff side. There's also medical costs that can occur after an accident. With more electronic and advanced vehicles on the road, there's a lot more specialized parts and specialized labor that's needed to make repairs to vehicles, and that's driving up costs for the whole system, not just those with those vehicles. And then there's, also the anecdote after COVID was that people were driving a little bit crazier when the roads were empty during COVID. And I think that's maybe gone down a little bit, but then miles driven from everybody is kind of rebounding since the pandemic. And then, as always, distracted driving and insurance fraud are issues that drive up costs across the whole system.
Okay. Well, one of the things you brought up was sort of about, new technologies. And along those lines, are there sort of any new vehicle safety technologies that have come out that may impact premiums down the line as they continue to be standardized?
Yeah, so some of the new things that are out there, the advanced driver assistance, features, some of the things like the warning when there's a car in your blind spot, automatically triggering your brakes if coming up on a car too quickly. A lot of those things are starting to get a little more standardized. I just got a car within the last year. I upgraded to like a 15-year-old car and just got a lot of these features. It's something I'm just starting to get used to. A lot of other cars on the road are just starting to get a lot of those. There's also, new airbag technology that's becoming a little bit more prevalent, which can help limit some of the more, life-threatening situations after an accident. And then telematics is also starting to get a little bit more advanced. I think that when people think about them, they think about the little thing that you clip to the roof of the inside of your car. And I think now that it's really folks who have opted into those systems, it's a lot of using your phone. So it's able to pull more data and, incentivize better driving behaviors. Some other external factors outside of new vehicle technology is stricter drunk driving laws, electronic traffic surveillance that can make a more dangerous area safer. But a lot of these are, as these things become more prevalent, we can see costs start to come down a little bit.
Okay. Also, some things that are more on the new side are the increasing prevalence of such vehicles as e-bikes and electric scooters. These personal vehicles are starting to become more popular, especially for those living in more urban environments where public transit is a bigger part of how people get to and fro, or they may not own a car and obviously looking for ways to traverse their hometowns. Are these vehicles things that auto insurance is taking into consideration?
This is actually something that we talked about in the last auto committee meeting earlier this week. I think the answer across the board was we're not sure yet. If anyone who's been in a downtown area has seen a scooter parked in the middle of the sidewalk, it's funny, I was driving home the other day and there was one that was just parked like right where the highway merged. So someone took it up to the shoulder where there was highway and just started walking. Anytime I'm walking my dog in my suburban neighborhood, there's an e-bike that goes by that will make him go insane. So they're starting to get a little more prevalent outside cities too. Some of the research that some of the committee members did was that they fall under like homeowners insurance policies a little bit more than auto. If you were to get hurt on one on your property. There's also, specialized policies for e-bikes out there in case of theft or damage damage or accidents, but I think that those are significantly smaller scale than auto insurance, and I think it's kind of a separate area from it as well. But something the committee's worth thinking about going forward.
Okay. So let's turn to some of the work being done by the Auto Committee right now. Are there any projects that are likely to come to fruition by the end of the year that's sort of being worked on at the moment?
Yeah, I was talking about affordability a little earlier. I think we're planning on a webinar with both the auto committee and the homeowners task force on affordability of those two personal lines. Some of the issues that'll be talked about in that webinar that we're aiming for sometime September that came up in the recent CAS presentation that the committee sponsored. We're also looking into a paper that we're drafting right now on the issue of telematics data portability. So whether your telematics data can go with you if you were to change insurers. So we're writing an issue brief on that, and if it gets some positive attention or there's more excitement around it, we might write a part 2 on it on potential solutions to the issue. And then we are also updating a paper from 2021, which is titled Consumer Costs of Automobile Insurance. That's on the Academy website now, and I think that we may have a 2026 version, hopefully by end of this year, that we'll be able to share.
Great. All right. Well, Rob, thanks for those insights. I appreciate it. I'm now going to turn to Margo and Jeff to discuss tariffs and their effects on personal auto insurance costs, an actuarial perspective, which was published in April. The paper, among other things, explains how tariff volatility throughout 2025 and 2026 has created substantial economic uncertainty. And Margo, to begin, what motivated the Academy to produce this issue brief on tariffs and auto insurance costs?
Very good question. So, as an auto insurance committee, we were putting our heads together, thinking through priorities for the year, actually back in early 2025. So, this has been in the works for quite some time. And that happened to be around the same time that tariff activity and all of the discussions around changing tariffs really started to take off. So, when we thought about auto insurance and the significant property component that underlies auto insurance, when you think about things like repair and replacement costs, costs of various auto parts, and just overall cost of automobiles, tariffs and what they could do, the potential impacts to the auto insurance industry, really seemed like a no-brainer for the group in terms of one of our key priorities. When you think about insurance in general, there are definitely a lot of insurance lines that we would think would be impacted by tariff changes, but auto insurance, again, just given that property component, is definitely one that we think will be pretty significantly impacted or more imminently impacted than some of the others.
Okay. And to sort of follow on the general topic, Margo, how does the current tariff environment differ from prior economic shocks that insurers have faced, such as inflation or supply chain disruption during COVID?
We actually thought about this specifically a lot when we were exploring the potential impacts of tariffs on auto insurance and kind of comparing and contrasting to what we might expect here to what we've seen with those other economic events that you mentioned. So I'd say the main overarching difference when we think about tariffs related to something like COVID-19, just using that as an example, given it was one of the most recent, I think it's still pretty top of mind for a lot of people in the industry. The main overarching difference is probably going to be the magnitude and the potential reach of tariffs relative to COVID-19. There's still a lot of uncertainty in the tariff landscape despite, being over a year into it. And how significant those will be with respect to claim dollars and premium dollars is still very uncertain. But in general, I do think we would expect the impacts from tariffs to be potentially a little bit more dampened than what we saw come through during COVID-19. So just to give an example, in our issue brief, one of the things that we explore as a potential impact goes back to something Rob was mentioning with respect to COVID-19, specifically those changing traffic patterns. So you had fewer people on the roads. Those people that were on the roads were generally driving faster. So we were seeing pretty significant increases in claim severity on the auto side. So thinking about tariffs, if we think about potential higher costs coming through, businesses seeing lower profitability and maybe being pressured in terms of, layoffs and that resulting in overall increased unemployment, could we potentially see a similar trend if you have less commuter traffic, fewer people on the roads, again, driving up those severities. But if you think about it from that perspective, if you compare to what we saw during COVID-19, that was a really big theme for auto insurance because you had massive business shutdowns, widespread shelter at home orders where most people just weren't going into the office at all, except for the people who were kind of mandatory to be in the office. So I don't think at this point we'd expect nearly that level of disruption. No, this is a very specific example, but just thinking about tariff impacts more broadly, again, the idea is that the impacts will probably be a little bit more dampened and there may be a little bit more control in terms of the impacts to a certain line of business than there were for COVID-19, just given how widespread COVID-19 was relative to tariffs.
Okay. Well, Margo, beyond those direct cost increases, the issue brief also highlights indirect effects such as recession risk and changes in driving behavior, which we sort of some discussion here. How material could these indirect impacts be relative to direct impacts?
Our expectation is that they could be pretty material for sure. We're definitely anticipating that those cost increases, the direct impacts that you mentioned, are going to come through. So we're going to see higher costs of autos, costs of parts, or already have, I should say. But similar to that COVID-19 period, like we've referenced a few times, a lot of the impacts that we're also expecting to see beyond just those cost increases are the impacts that we're expecting to see more to things like the overall economy, economic outlook, changes in inflation, things of that nature. And to provide a little bit of context on that, again, relating back to the COVID-19 pandemic, since it was one of the most recent economic events like this, in my role as a consulting actuary, I had quite a few clients where they didn't really see a lot of direct impacts from COVID-19. So they weren't seeing any direct reported claims from COVID-19, but they were still seeing a lot of disruption in their data and just in their overall operations and business because of those indirect impacts. So all of the changes to the economy, driving behaviors, all of those different, again, indirect impacts were a lot more significant for a lot of my clients than what we saw on the direct side. So again, very different landscapes when you look at COVID-19 and tariffs, but we are drawing from that time period to understand what we might see with tariffs. And we would definitely expect the indirect impacts here to be pretty significant like they were during COVID.
Okay. Well, Margo, thank you for that. Appreciate it. Jeff, turning to you, how has the current rapidly evolving tariff landscape complicated actuarial analyses in the personal auto insurance space?
I think there are a few areas I'd like to kind of highlight here. One around the fluctuating tariffs and the impact that they've had on the imported auto parts and vehicles have really caused some significant volatility in manufacturing costs and vehicle prices. You can see just how much some of those tariffs have varied from, Canada to Mexico, China, and just how significantly those have fluctuated as well. You saw them, maybe as low as 10%, go up to 25, 40%. So just that volatility really in manufacturing costs is going to have a significant impact. Second, I'd call out the supply chain disruptions. Those also have led to delays and shortages of replacement parts. And so as it takes longer to get a vehicle repaired, and so that just kind of complicates the cost estimate. And sometimes they can add loss adjustment expenses that can add to it, and that's one of the things we called out in the paper is additional direct impact there. And then third, I'll just highlight the additional inflationary pressures related to tariffs and their trade-in uncertainties. Just the impact they have on variable inflation rates. So this volatility has really kind of made it more challenging to rely solely on that historical data, which is really traditionally what the actuaries use as the foundation of our actuarial analysis. And so that uncertainty around future tariffs and inflation further makes it more challenging for the actuary in projecting those future costs. Therefore, actuaries need to really incorporate more than just that historical data. They need to consider a broad range of information beyond that historical data, such as economic indicators, supply chain factors, tariff scenario analysis. Really, you want to bring all that together to make the most well-informed pricing and reserving decisions.
Okay. So, how should actuaries approach the use then of historical data in a tariff influenced environment where past trends may not be applicable?
Yeah, sure. So, when the experience period that, the actuaries are using for their analysis spans varying tariff levels there, it's necessary to really kind of think about potential adjustments that need to be made there to the historical loss development and trend data. And so that really helps account for some of the structural changes and cost drivers that are caused by, shifting tariff regimes there. It's important that you consider scenario analysis as well, because I think it plays a crucial role in allowing the actuaries to model a range of possible future cost outcomes, using different tariff scenarios. And so you can just see how sensitive the impacts are from those different scenarios. And that really enables a clearer understanding of just what impacts you can expect to see. And so if the impacts are small from your different ones, it can build some more confidence around it. Whereas the wider those are, you might need to go a little deeper and kind of make sure where your comfort level is with it. And really, given the complexity of the tariff impacts here, historical data should be supplemented with relevant external data sources, as I was mentioning a minute ago. And so that includes the things like tariffs, supply chain dynamics, inflation trends. All those can provide valuable information to kind of help us in having that forward-looking impact there that you can't just really capture from only looking at historical data. And then the rapid changes in the tariffs really that we've seen over the past year highlight just the importance of regularly updating those assumptions in the rate making process. And so frequent model reviews, assumptions, testing those, just make sure that you're being as responsive as you can to the current environment when you're making those projections for the future.
Got it.
And if I may, another thing I would say to potentially consider when thinking about the historical data, because as Jeff mentioned, it is very challenging in these times where one of the key assumptions underlying a lot of our analyses as actuaries is that past history is predictive of the future. So, one thing to consider when you're looking at the history is, are there any other periods of disruption within the history that might be similar to this tariff landscape that you could potentially rely upon as opposed to the entirety of the history if you're trying to understand how the data may be impacted or how future development or future trends may come in? For example, again, going back to COVID-19, it's a period of significant disruption. Is it possible that that's a time period that the history might be reflective of what we're going to see during this tariff landscape? Not necessarily suggesting that COVID-19 is the period that you should look to, but just in general, food for thought in terms of thinking about what time periods you have in the historical data, what other economic events have taken place, and are there any therein that might be potentially reflective of what you'd expect, at least to some degree, under the tariff environment.
Thank you, Margo. And just following up with you, different question, but how should actuaries approach disclosure of tariff-related uncertainty in the statements of actuarial opinion?
So I think before deciding how you want to address it and how or what to disclose, either in an opinion or even other actuarial work products like a report, it's important to try to think about the actual impacts that have come through and the potential impacts that you might expect to see that haven't come through yet. And think about those from all different angles. Again, not forgetting about those indirect impacts. It's easy to think when you're thinking about the tariffs about those direct impacts and the cost increases, but try not to forget about those indirect impacts because those can be the kind of sneaky ones that aren't really always top of mind, but can have a pretty significant impact. I think on the tariff landscape, things have evolved a lot differently and probably a little bit more slowly than a lot of us were originally anticipating, but there's still so much uncertainty. I think that part remains true, the uncertainty piece. And even if it's still difficult for us to actually put numbers around this and start to quantify it, the uncertainty shouldn't be overlooked or certainly shouldn't be omitted. And it really is a key component of helping whoever the reader is or the user of the actuarial work product just get the full picture and understand where the risks may be. So just very important to consider it really from all different aspects. I think disclosing that there is uncertainty with respect to tariffs, if you feel that that's the case for a particular insurer or a particular company, it doesn't necessarily mean that you're guaranteeing that there are going to be negative impacts. So it shouldn't be viewed as necessarily a negative thing, but it just gives the reader some useful context and something to think about as they're interpreting the results that you've included within your opinion or your other work product.
Okay. So, as some listeners may be aware, the U.S. Supreme Court had a ruling earlier this year that affected the administration's tariff powers and the impact it could have on the insurance industry. Jeff, can you just give us a little insight on the effects there?
Yeah, that's certainly something we were closely monitoring as well here. And you're right, that ruling invalidated, the International Emergency Economic Powers Act. That was the ruling by the Supreme Court. So it really rendered those tariffs illegal, as you said, Ted. So in response, the administration shifted to a kind of a new legal basis for the tariffs. So they didn't just eliminate them, but they put in new tariffs starting at 10%, which they later increased to 15%. So I think one of the things you did see with that is that there's maybe less variation in the country of origin there for those parts than we saw maybe back in 2025. But as we look ahead here to the future impact, I think one will have to see kind of how does this new legal approach play out. There's still some uncertainty around that. Will it be challenged? Is it temporary? Those kind of things. But if these tariffs remain in effect, they certainly could lead to higher costs for auto parts and contribute to ongoing supply chain volatility. If there's more certainty in it and maybe stability there, so there's less variation, by country, such as, are the parts coming from Canada, Mexico. If there's more stability there, they'll give the actuaries a little more certainty as it looks ahead. But I think you still need to consider when you're looking at that historical data and what were the tariffs in effect kind of during that time period in 2025 as well, too. So I think you have to consider both the historical data as well as what you're anticipating that when you're making that forward-looking view of things.
Okay. So let's just do a little forward look ahead here. Margo, are there areas of tariffs topic that you would prioritize for further research or data development from the Academy's perspective?
Definitely. I'd say a natural next step on, what we've built in terms of the issue brief would be trying to explore the quantification side of it. So, like we had mentioned, our issue brief was really focused on the qualitative side, trying to identify some of the potential impacts you might expect to see, again, qualitatively, but we didn't get into any of the numbers for various reasons, including there being so much uncertainty and things evolving so quickly. So I think that to me feels like a natural next step, definitely probably a more challenging next step, but would be interesting to explore what the numbers actually look like. You'd certainly see a lot of uncertainty there. So just like the qualitative that we've discussed today, the quantification of that would be subject to just as much, if not more, uncertainty. But it would be a worthwhile next step to help supplement what we've covered as far as those qualitative considerations, especially given where we are now in 2026, potentially having maybe a year or so of data under our belts to compare against prior data and say, are we seeing any signs of tariff impacts, whether they be direct or indirect, coming through in that data, which is data that we didn't have a year ago when we first started exploring this issue brief. So from my perspective, I think trying to quantify it will still be very, very challenging, but would be an interesting next step.
I agree with Margo there. I think that the quantitative side is key there. One of the things I touched on this briefly, but I think trying to break it down maybe by the type of vehicle here and just given where they're manufactured would be part of the interesting study, I think, to do here to see how much did those vary given how some of the tariffs did vary, particularly in 2025.
Okay, thank you both. Before we go, I wondered if there might be sort of any other aspects of the tariff issue or this paper that we sort of haven't touched upon here that either of you might want to discuss.
Sure. So I can kick it off. And then if you have anything you want to add, Jeff, I'd say one thing that's top of mind, I think we'd be doing them a disservice if we didn't raise on an actuarial podcast the topic of the ASOPs. So when you're approaching these types of uncertain events like the tariff landscape, from an actuarial perspective, I would just say never hesitate to consult the actuarial standards of practice or those ASOPs. Within the issue brief, we specifically call out as examples ASOPs 13, 36, 41, and 43, but there are definitely ASOPs that could be helpful. And just in general, there's a lot of useful guidance in the ASOPs for situations like this. You won't necessarily find any direct references to tariffs therein, but you'll see more broad guidance on times of change, times of uncertainty, and ways that you might consider that and things to keep in mind. So as an overarching theme, don't forget about the ASOPs when you're trying to navigate the uncertainty of things like tariffs.
That was where I was going to go as well, Margo. And I think what we tried to do with the issue brief as we reviewed the various ASOPs there, we had potential considerations, which I think help provide good thought starters as you're referring back to those.
Okay. Well, thank you, Margo, Jeff, and Rob, for all the insightful discussion here today. To learn more about all the great work of the Academy's Casualty Practice Council is doing, go to www.actuary.org. My name is Ted Gotsch, and I'm very pleased to have had the opportunity to host this episode of Actuary Voices, the podcast from the American Academy of Actuaries. Visit our website at actuary.org to learn more about all we do here at the Academy. You can also follow us on X, Facebook, and LinkedIn. And don't forget to subscribe to this podcast at your favorite podcast platform. Until next time, be well.